Let's now shift focus and let's discuss the state of the economy, not just India, but what's happening around the world. And who better than Chetan Ahya, Chief Asia Economist at Morgan Stanley, joining in to talk about exactly that. Chetan, hi, good to have you on the show. And good speaking with you once again. And I was just going through your latest notes, and in your mid-year outlook, you've highlighted the resilient domestic demand when it comes to the Asia region. Tell me, which countries do you see as the most insulated from global shocks in the second half of the calendar year?
So in the region, we think that India and Australia are relatively insulated, and then we are also constructive on Japan, because Japan's story has essentially been the one of reflation, i.e. that they've been sort of moving out of deflationary environment to more moderate inflation environment. And we think that that story is relatively intact. It's also supporting their domestic private consumption, with wage growth picking up and supporting domestic demand. So we are constructive on India, Australia, and Japan to the extent to which it has support from domestic demand as well.
Let's talk about India then. And since you've revised your growth trajectory when it comes to India upward, tell me, what are the key drivers sustaining this momentum despite the global headwinds and just still that big overhang of tariffs?
Well, so I think India's major relative advantage is that its goods exports to GDP is just about 12%. And for rest of the region, it's in the range of like 20 to 50%. So India is relatively insulated to the extent to which its exposure to global goods trade cycle is much lower than everybody else. And at the same time, it has this structural domestic demand story, which is also much stronger than the rest of the region. And this is coming in from the fact that the government policies are very focused on pushing in investment. And if you see the trajectory of Indian government, both center plus states taken together, revenue expenditure versus capital expenditure, both the lines are moving in the right direction. Over the last 5 years, we've seen a consistent decline in revenue expenditure to GDP, and that has been taken as an opportunity by the government to increase its capital expenditure to GDP. And that's what we needed, right? We have the right demographics, but what we need is the right policy environment that is focused on boosting investment and job creation. So that government focus on boosting investment has been also sort of been a key driver of India's strength in domestic demand. And then, a factor that has been underappreciated is the strength in services exports. Now, I know at some point of time you will probably see some slowdown in services exports for India too, but to the extent to which a part of this gain in services exports growth is because of market share gain, and in the backdrop, a big expansion in the addressable market post-COVID, where there's a general perception that has been going around in countries like the US that if you can work from home, you can work from Bangalore, and that sort of led to a major expansion in the addressable market for services exports. And then India is also gaining market share in that growing addressable market. So both those factors have kept the resilience in services exports. As you saw just very last month, services exports grew by 17% on a year-on-year basis. So we think that India's story has been buffered by the structural strength in domestic demand and resilience in services exports.
Sure. But how does a divergent monetary policy path in Asia and pretty much all across versus what the US Fed is doing, does that really pose as a risk or an opportunity? Does it really create more capital flows into India?
So we think that, yes, it could have been even a constraint for Asian central banks to cut rates to the extent to which the Fed is still on hold. But I think the most important driver to a region's central bank's policy thinking is what is happening to the dollar. So in 2018, when tariffs were imposed, you had seen that dollar was rising. And even while tariffs were deflationary for the region, like it is right now, and causes a slowdown in growth, central banks were having to hold back their rate cuts until the time that the Fed started to begin thinking about taking up its own rate cuts. But in this cycle, to the extent to which the dollar has been weakening, Asian central banks have been going ahead and cutting interest rates. And just by the fact that investors are outside of U.S. thinking about hedging their exposure to the U.S. by way of concerns on weakening dollar, that's actually causing further weakness in the dollar and giving some support to the capital inflow into rest of the world as well, particularly Europe and Asia.
But what about the other part of the puzzle, which is inflation? Because in your note, you've talked about as to how disinflation in Asia's core economies is something that you're penciling in or foreseeing. What's your base case for interest rate cycles in India, and how do you think that's going to play out when it comes to affecting the capital flows? Because what we're working with is another 50 bips for the rest of the calendar year. At least that's what the consensus on the street seems to be. And, it could be as steep as another 25 bips cut on Friday.
Yeah, so I think for India and the region, we are having a starting point of inflation which is relatively low. We are seeing decline in oil prices further causing disinflationary pressures. At the same time, we've seen tariffs going up. Tariffs are always deflationary for the countries on which tariffs are imposed. And you add to that weakening dollar, i.e. strengthening of Indian rupee as well as other Asian currencies. So you are going to see inflation decelerate further, and that allows the central banks to cut rates more meaningfully. We're expecting 2 more rate cuts from the RBI. And we are also highlighting the risk that RBI could take up a 3rd rate cut and take the cumulative rate cuts from here to 75 basis points. If you see that the growth damage out of the global trade slowdown turns out to be more than what we are building in right now.
Right. Chetan, you've often talked about India's capex cycle and that you see it actually picking up. Tell me, how is it that you actually see it shaping up, and the kind of divide between private capex and government capex? How do you see that evolving?
So we think that the government capex has actually been the key anchor of the capex cycle. And to the extent to which India has been sort of embarking on this focus on manufacturing capex, the government's focus on infrastructure would be an important anchor to that private capex eventually improving as well. And so right now it is still the government capex, and we had seen a bump down, sort of a small slowdown period for government capex post general elections last year, but we've seen that in the last 3-4 months there has been a meaningful pickup in government capex. In fact, in the month of March, we saw that both central and state government capex grew up at a very high pace, and that's now taken 12-month trailing center plus state combined capital expenditure to close to the peaks that we had seen right before general elections. So we've seen this strength in government capex coming back again. As far as private capex is concerned, we were expecting that would have picked up a lot more by this time. But to the extent to which we have seen this trade tensions emerge from early this year, that is going to affect the capex outlook not only in the region but also in India. Despite the fact that India has a lower exposure to global goods cycle, the reality is that it still has meaningful exposure of 12% of GDP being its goods exports to GDP. So we are expecting private capex to be going through a bit of an adjustment period in the environment of global trade tensions. And then over the next calendar year, that is in 2026, you should see pickup in private capex, because by that time we think that the damage out of this global trade tensions would have been behind us.
Talk about the China angle here, Chetan, and to what extent do you think India is benefiting from the supply chain diversification away from China? Because, you know, this is something which has come up time and again for many years now.
So I think India is definitely benefiting on account of it. Right now, also during the period where tariffs on China are, even after having come down, are still at a very high run rate. So 30% has been the tariff that has been imposed from this round. And from 2018 period, you also have about 11% weighted average tariff on imports from China that the US has imposed. So cumulatively, we still have 41% tariff rate for imports from China for the US. And that does give some sectors an advantage over China in terms of pricing, and even, you know, sort of thinking about a bit more from a medium-term perspective. Corporate sector in America is beginning to think about importing more from India. So India is benefiting probably on account of that. And then from a medium-term perspective, we've always argued that, look, it's not just about, you know, taking away market share from China, but just getting rightful market share for India in the global goods exports. And for that, it's India's policies that were important, and the government has been taking the right policies to boost that manufacturing sector exports. We've seen the electronics manufacturing getting a leg up. We are going to see that expand more into more and more products within the electronic segment, apart from mobile phones and laptops. And at the same time, we think that, you know, from a medium-term perspective, this whole push towards infrastructure will really strengthen India's manufacturing exports. So it's really a lot of the domestic policies that will be important from the long term, apart from the short-term benefit that it may get on account of differential tariff rates between India and China.
Right. Chetan, out of curiosity, the current optimism in the Indian equity markets, do you think it's aligned with your view when it comes to economic fundamentals, or do you see any areas of overheating or correction risk?
Well, you know, both our regional and India strategists have been very constructive on India. So we are aligned up as a house on being bullish on India.
Great to have you on the show, and you have a great conference.
If you like this video, then like, share and subscribe to ET Now.